Welcome to the Link edition this week, and this is the Insurance Week, where the insurance industry engages the audiences and customers for education, and we won't leave ourselves out of that. And my guest tonight is Mr. Emmanuel Mwaka, who is the chairman Life and Pension at the Uganda Insurance Association, but he also works for ICEA as a company. Emmanuel, welcome.
Thank you, Samuel.
Paint for us a picture. Today we're talking about life insurance, and I know it's one of the fastest growing for you insurance guys, because it has an appeal, it has a life issue. When we talk about life, people want to say, okay, I'm interested. So paint for us a picture briefly of what life insurance actually means.
Thank you very much, Samuel, and thank you for the opportunity to educate the public about what life insurance is. Life insurance, basically, as you can hear, the two words, there are two unique words. One is life, the other one is insurance. Life basically means everyone that has breath within them, and then the insurance, of course, is the protection of assets, the protection against loss. Life insurance, basically, in simple terms, is financial protection. If you have that dream that you would love to achieve, if you have that vision, and there is a risk that you might not be able to actually meet it, and that risk could be either coming out of death, out of a critical illness. Life insurance comes in to actually meet that need. Life insurance also is can be described as insurance that's taken by someone that loves you, someone that needs you, someone that requires to actually make a point to say that this is a person that I put value in, and this can then be taken actually by corporate companies looking after their staff, to say that, you know, Emmanuel as an employee is very important, Samuel as an employee is very important, and we want to ensure that if we were to lose Samuel during the course of work, that we actually thank his family for giving him to us to work with us. That is another form of protection. So life insurance basically looks at lives and looks at what's at stake for each life, and then comes in to protect what's at stake for each life.
So who is insured, Emmanuel? Is it me who goes to the insurance company? Who do I insure? Because if I'm dead, then what am I insuring?
So you insure an interest. You do not really insure yourself per se, but you insure an interest. So insuring an interest basically means if Emmanuel goes to take insurance, Emmanuel will state who his beneficiary is. The beneficiary for Emmanuel will be his children, his family. The beneficiary for Samuel will be, you know, the beneficiary for NTV will be the employees of NTV. So you insure an interest.
So it's not me, it's like the beneficiaries, other people.
Yes. But I would say, Samuel, that how you insure yourself as well is to say that in the event that you do not die, in the event that you do not get a critical illness, in the event that you do not get a permanent total disability, you have effectively insured yourself, because as a life insurance company, we will still pay if you take up an endowment plan. So we'll still pay at maturity if you do not pass on. If you say, if it's an education plan, you will then effectively have insured yourself from, you know, let's say financial distress in the future. Very
good. Now, what are the obligations of an insurance policy holder like me? If I came to you, what are my obligations and what are your obligations? Because people think, okay, I'm going to just give money. No, there are issues involved. So clarify for us, what are my obligations? What are your obligations as a company?
So, Samuel, that's a very interesting question, because there is never a party that is more advantaged than a policy holder. But the main obligation of a policy holder is utmost good faith. You must state clearly and correctly the information that is required by the insurance company for them to cover you. Secondly, you must honor your obligations, and the obligations typically for any life insurance policy to take effect are for you to pay your premiums, which means you must pay your premiums faithfully and diligently. And in the instances where you have failed to pay your premiums, you must inform the insurer that, you know, I have failed to pay my premiums and I would either want to take a break for this period or something of the sort. So those being the most critical obligations, you know, we can add the others. Say if you're required, say, to go for medical examinations, it's your obligation to actually go and take those medical examinations. If you're required to do anything else by the life insurer, you're required to actually do that. But ultimately, you must also sign off on the policy, which is the contract with the life insurer. On the other hand, the obligation of the life insurance company, I would say, you know, take it a notch higher. The life life insurance company must also be held for its word. So it's a promise that the life insurance company is giving, so which then requires the life insurance company to make sure that the promise it's giving it can't fulfill. So there is the principle also of utmost good faith by the life insurer to the policyholder that it's giving the commitment. The life insurer must, of course, receive your premiums and confirm to you that they've received the premiums by issuing the receipts. The life insurer must, at the time when there is a claim or at the time when there is maturity, must honor its obligation that it set at the time when you actually took on the policy. So the long and short of it basically is that the life insurance company, the biggest obligation it has is to actually make the policy come to life, to respond to any trigger. The triggers could be a permanent total disability, a critical illness, or even a death. So the life insurer must then must make good that contract that is existing between the life insurance company and the policyholder.
Okay. And I know because each of the parties, the policyholder and the insurance company have obligations as you have mentioned. What are the common areas of contention that we need to take note of, and how are they sorted?
Okay, so the typical areas of contention, mostly for life insurance, given that these are long-term policies and contracts ranging, say, between 5 years and above, 5 to 20 years. Typically, what happens is there are, in some instances, changing financial fortunes for the policyholder that require the policyholder maybe that make the policyholder fail to pay premiums. In those instances, there will be contentions because, one, the policyholder believes that they require a refund for all the premiums that they've paid. It might seem obvious, but it's not obvious because the time when the policyholder was paying premiums, they were actually on cover for the total sum assured. So that's an expense that the life insurance company is actually taking. And insurance is typically about pooling risk, and so is life insurance. So if there are 1,000 Samuel Setumbas who've taken life insurance covers, there's a likelihood that maybe 1 to 5 of them will suffer an incident during, let's say, the first 1 year. Now, the principle of insurance then is to pool risk and to make good the promises from that pool of funds. So if Emmanuel, who is in that pool of 1,000, does not suffer any risk, Emmanuel has actually borne the brunt as well because he's part of that pool, he's still protected. So life insurance basically gives you peace of mind. That peace of mind comes at a cost, and that cost must be honored in a way. So at no point then would premiums be refunded if there was risk that the insurance company took at the time when you are paying your premiums diligently. To
give an example, Emmanuel, if I have 5 years of cover and somehow along the 3rd year I have financial issues and I can't finish the 5 years, 3rd year I have issues, I can't finish the 5 years. So all the 3 years of saving is gone.
Somewhat not entirely true. So there are different nature of policies. So life insurance companies have different types of policies. I'll explain a policy which is most common, and that kind of policy typically has what they call the surrender value. So the surrender value typically, in most instances, is attained at the time when a policy has paid 36 months. So you've paid 36 units. Now, the surrender value is, in most instances, not a direct refund of the premium that you've paid, but it's a portion of the cost that the insurance company, has incurred to cover you. It's deducted from what you've paid, and then they add on interest for the amounts that have been remitted. So you get back something. Now, the insurance company in those instances maybe will give you back, let's say, between 70% to 110% of what you had paid as premiums, depending on the nature of risk and the amount of risk that was covered in the policy that you took. So I would say categorically that in no instance would you find that you're being cheated. The higher the risk the insurance company covers for a period, the higher the cost it actually incurs. The lower the risk component the insurance company covers, the higher would be the refund in that instance where you've gone into financial difficulties. But Samuel, I'd also add that the insurance company may also opt to, give you a waiver period to say that, if you've gone in, if you're currently experiencing financial difficulties on attaining the 3rd year, then let's take the insurance policy for a break, maybe for 5 months, 6 months as you sort out. And then you'd find that the insurance company can then opt to reinstate the cover on the 7th month, and you would then continue as if
nothing happened.
Nothing happened.
I don't get penalized for that?
You wouldn't get penalized.
Okay.
Yes.
Finally, in 20 seconds, I've been told time is running out. In case a consumer is unhappy, we don't agree, what do we do?
No, there are very many points of recourse. One, you can raise a complaint to the insurance company. There is a procedure. If that procedure is not sufficient, then that can be escalated to the Insurance Regulatory Authority. They have a complaints bureau that handles, and they come and mediate through. And if that's also not sufficient, there is an insurance appeals tribunal. That's the next level, and then that can go. It can go to the judicial courts.
Okay.
Yeah.
Thank you very much, Emmanuel. I wish we had more time to break down these things. And viewers, again, sometimes we bring technical subjects where your money is concerned. Go back and watch these videos once again. Slowly, you get to understand what Emmanuel is explaining at speed, because we don't have time. Thank you for joining us, and we hope you enjoy the Insurance Week. Ask your company as many questions as you can and let them tell you all that you need to know. That was the link. Thank you for joining us tonight.